Okay, do me a favor. Let's stop talking about the Minister of Finance. Let's stop talking about the CMHC changes. $1.5 million is the new cap for insured mortgages, 30-year amortizations, and it may be a bailout for new home building. It may be an attempt for the federal government to try to bring more building, new construction back online. But let's not talk about that. I want to talk to you about what's really going to impact interest rates going forward now. Two things happened this week. Number one, the Federal Reserve dropped interest rates 50 basis points in the United States. One nice big jumbo cut, right? And Jerome Powell seemed really relaxed. I mean, like I watched it, I thought he looked relaxed, but everybody's saying he looked relaxed. And the reason why he's relaxed right now is that the bond market in the United States and the Federal Reserve are in sync right now. So he is saying that he gave 50 basis points to the market. He's going to give another 50 basis points in cuts over the course of the next few months before the end of the year. And then he's going to give 100 basis points, which is kind of consensus amongst the FOMC members, another 100 basis points in 2025. And this is all priced into the bond market in the United States. So it's kind of like a nice, stable coexistence between the two, which hasn't really been there for the past 2 years. The other thing that I noticed in his speech is he was really clear in explaining that it's a relationship between unemployment and inflation, and that now it's the Federal Reserve's job to start targeting unemployment, because even though the unemployment numbers haven't gotten out of hand in the United States yet, they will if the Federal Reserve leaves interest rates high for a prolonged period of time. Back to Canada, though. In Canada, we had some really big news last week. Our news was that the CPI number in Canada came in at 2% for August. Consensus was 2.1%, and we ended up below that. Now, this may be something where economists could look at it and say, well, it looks great. We've hit our target. We need to be careful still with inflation. So maybe, gradual rate cuts. I disagree. If you look at the CPI number for Canada in the month of August, the biggest component was shelter. And shelter costs are mortgage interest. I mean, there are rents also, but for the most part, it's the interest people are paying on their mortgages. And since it's a year-over-year number, and since Canadians are continuing to renew their mortgages throughout this period, that number, being such a huge component, is going to erode, because as interest rates fall, that number will become less and less of a factor in CPI. I believe we're going to start seeing CPI prints that are below the 2% mark very soon as mortgage rates start dropping. Today, I want to talk a little bit about where rates are supposed to go, and then, more importantly, what you should do with your mortgage, okay? So, we saw shelter costs being a huge component of the CPI number in August. We saw the CPI number in August for Canada be 2%. We see the Federal Reserve drop interest rates 50 basis points. What happens next? Well, we've been saying this now for the last couple podcasts. The first step is an October cut. As of today, as of right now, when we're sitting here, the overnight rate in Canada is 4.25% and the prime rate is 6.45%. By the end of the year, October and December meetings, we will be lower by at least 0.75%. Now, things change, right? Like we could see a really bad unemployment number. We could see CPI continue to erode, which we may very likely see, as I said, in which case we may see even more than 75 basis points. We may see 100. But if we see 75, overnight rate by the end of the year will be 3.5% and the prime rate will be 5.75%. Next year, in 2025, we get 8 meetings. Every year we get 8 Bank of Canada meetings. Over the course of those 8 meetings, consensus is that the overnight rate will drop to between 2% and 2.5%. So that's another, 1 to 1.5% off of the end of 2024 numbers. leaving us the end of 2025 with a prime rate of 4.25%. What do? So I've heard a lot of different real estate agents and mortgage brokers, and I've read some newspaper articles of people advising Canadian borrowers to hold and keep their mortgages as they are right now. And I agree, it is not time to renew a mortgage early, especially it is not time to renew a mortgage early into a fixed rate. But what we've seen happen typically in these types of economic environments in the past is that the discount off of variable rate mortgages starts to erode in times of economic uncertainty. So whereas right now you can get a variable rate mortgage at prime -1 or prime -20, so that 6.45 prime rate that we're sitting at right now, you could end up with a 5.25% variable rate mortgage. Those variable rate discounts will very likely start to shrink. And when they shrink, it means that you're going to get less of a discount off of prime locked in for the next 5 years. So it's time to start contemplating whether you may want to break a mortgage in order to get a variable rate mortgage, because the discount on variable rate mortgages will start to shrink. If the Bank of Canada starts cutting rates aggressively, which is what we believe will happen, it will be doing so as a response to economic uncertainty. And when there is economic uncertainty, and we've already seen in Canada, loan loss provisions for the banks are going crazy. Royal Bank of Canada issued their arrears for their mortgages. They are up huge. I mean, still a very small number from a percentage basis, but the month-over-month increases in delinquencies on mortgages is starting to be alarming. And when those pieces of financial data start coming into the banks, that affects the pricing on that variable rate mortgage discount. And you can think about another thing too. If you got a fixed rate mortgage right now and you want to break it to go into a variable rate mortgage, and let's say you got it 2 or 3 years ago, within the last kind of 2 years, fixed rate mortgages have been consistently above 6%. So if you want to break a 5-year fixed rate mortgage, they calculate your penalty using interest rate differential, as you probably know by now. If you need more information on that, I'm sure we've got an old podcast or something that we can pull up. But if they're calculating the penalty based on interest rate differential, the penalty will be less now, very likely just 3 months interest, because the 3-year fixed rate, so when they charge you interest rate differential, I'll just give you a quick rundown on it now so you don't have to go back and look at an old video. But when they charge you interest rate differential, they take the interest rate that you're paying on your mortgage and they compare it to the interest rate on a mortgage with the same length of time that you have left on your maturity. This is a way for the banks to say, you are paying your money back to us on your mortgage, and we need to make up the difference, the differential, between what we can lend that money out now today. Well, if the 5-year fixed rate is 6% on your contract, and the 3-year fixed rate, because you have 2 years left on your mortgage, is 6%, then they won't charge interest rate differential. They'll charge you 3 months interest. But if we're in an environment where interest rates are trending lower, that rate that you will have to be using to calculate the penalty on your mortgage will continue to drop. And as time goes by, your mortgage will now be compared with, for the differential, a mortgage with a shorter maturity. So if a year goes by before you break your mortgage and you're breaking with 2 years left, they will compare it to a 2-year fixed rate, which will also be lower than a 3-year fixed rate. In addition, rates will have trended lower. So I think that we've got to be careful. Canadians could start to get caught on this interest rate differential penalty. It's an important thing to navigate. Now, just to recap this, interest rates are going lower. We know they're going lower. The Canadian economy is in trouble, right? We've got mortgage delinquencies rising at the banks. We've got the real estate market not doing well at all right now. The Bank of Canada sees these numbers coming in. They understand CPI. They understand that the the biggest chunk of that CPI number right now is mortgage interest, and that's going to fall away very soon. And once that falls away and our CPI numbers start dipping below 2%, you can rest assured that interest rates are going to come down faster than people already anticipate. Look for more cuts coming in 2024. Look for a lot more cuts coming in 2025, and prepare yourself to get into a variable rate mortgage while the discounts on those variable rate mortgages are still more than prime -1. Now, for this, you need to speak to somebody. So if you trust the person at your bank and you believe that they're working for you, speak to them. I would always recommend you speak to a mortgage broker. It doesn't have to be us. We'd love it if it was, but find someone that you work with, that you trust, and have them guide you through this process. I think that over the next 6 to 12 months, it's going to be critical, and Canadians can save a lot of money if they do this properly. This one simple trick. Pay attention to it. Thank you.